Good afternoon, everyone. Good afternoon, everyone. On behalf of Women Members Excellence Committee of ICAI, it is my pleasure to welcome you all to the Yashaswini and Idol Series 43. Yashaswini and Idol Series is a Wednesday series of programs conducted by the WMEC for the women CAs and by the women CAs. This series is an extension of Sky High Symposium, which concluded its 100 episodes. It is one of the committee's initiatives to not only disseminate information to women members on technical updation and non-technical skills, but also to empower and inspire women members to come at forefront and realize their verbal skills at public forum. CA Sushila Thakur is a chartered accountant with 18 years of experience, including 12 years in NRI and international taxation with KPMG, Siemens, and Grant Thornton. She has running her own CA firm for 4 years and specializes in tax compliance, advisory, and transfer pricing. Additionally, she holds LLB degree, which she completed in 2022.
Hello.
Over to you, Sushila ma'am.
Yeah. Thanks, Ria, for the introduction, and thanks to the entire WMEC association for taking this wonderful initiative for women. It boosts our morale. I'll start with the presentation. So the topic for today is NRI taxation and startup advisory. Hello.
Yes, ma'am.
Yeah.
You may please continue.
Yeah. So the topic for today is NRI taxation and startup advisory. So we'll break it into two parts. First, we will discuss on the NRI taxation and then the startup advisory in the second part. So the topic of NRI advisory is a vast gamut. NRI taxation in itself, considering the global economy today, it is an association of different countries working together, and that's why the movement of people from one country to another is a regular phenomenon which is happening these days. And that is why NRI taxation has become a crucial thing to be yeah, hello. Yeah, actually I had done it. You have taken the control. Yeah. So moving to the agenda, we are having different important aspects into NRI taxation, which needs to be looked into, starting with what actually a NRI is. So a non-resident Indian is an Indian citizen who is going abroad for any reason, be it employment or for the business purposes or any other reason. And accordingly, whatever income that NRI earns, how the taxation of that will be considered and how it should be taken care of, how to be optimally guiding those NRIs. That is our role as a professional. So in our entire presentation, we will cover both the aspects, like what the NRIs or the SSEs should be taking care of, and what they should be knowing about, as well as a professional, what is our role to simplify their lives. So I'll cover both the aspects. So starting with the first aspect, which is the residential status, which is the most important aspect of NRI taxation, because the entire complications and entire whatever clauses are there in relation to NRI taxation, it revolves around the residential status, that how many days that NRI stayed in India, what was his presence in India, what he has earned in India. So those aspects needs to be taken care of. So residential status, basically, section 6 is the key section which covers the NRI residential status thing. So a resident is divided into being a resident and a non-resident. In the definition of the resident, there is a bifurcation, which is a resident ordinarily resident and resident not ordinarily resident. So to simplify it further, the section 6 has the aspects of the number of days of stay which has to be looked into when it is considered for being a resident and a non-resident. So individual, when he is considered to be a resident, in a particular financial year in India is from 1st of April to 31st of March. In a particular financial year, if a person has stays in India for more than 182 days in a particular financial year, then the particular individual is considered as a resident. There is one more clause to it. If the first condition is not fulfilled, the second condition is that if the person has stayed in India for 60 days or more in the financial year and has been in India for 365 days or more in the past 4 financial years. So the first section does not have anything combined with it. It is 182 or more days in one financial year. The second condition is 60 days in one financial year and 365 or more days in the past 4 financial years. Now, once this section is considered, for the 60 and 365 clauses, that condition, you have to read it with some more subsections to it, to determine whether the SSE is a resident, ordinarily resident, or a not ordinarily resident. Why these definitions are important? Because the taxability of any income of that particular NRI will be determined basis he is an ordinary resident or a not ordinary resident. When you read it from the Act, it may sound a bit complex, but if you simplify, it is not a rocket science to understand it. In very simple words, if an individual has been a resident for 9 out of 10 years in the preceding to the relevant financial year. For example, you are considering and residential status for the current financial year. So you have to look for the past 10 years, what was his residence and what was his status. And if the person has stayed for more than 730 days for the past 7 years preceding the relevant financial year, then that person will be considered as a resident, ordinarily resident. So you can read it other way around, as mentioned in the section, that if an individual is not a resident for 9 out of 10 years and stayed for less than 729 days for 7 years preceding the relevant financial year, or you read it the other way around, it's one and the same. But the meaning is one and the same. It's simple that if you first fulfill the first condition of 182 days, you're directly a resident. If you go into the second condition of 60 plus 365 for the past 4 years, you get into these two conditions, the subsections. Now, once this is done, you know that what is the exact residential status of that particular NRI for that particular year. Now, coming up to the best practices, what can be done to ensure that this thing is error-free for your clients? The best practice is a proper counseling to be done for the NRI. So when a NRI is moving from India, it is our duty as a professional and as a chartered accountant for that particular client to guide them in a right way. So I have seen in my tenure the cases that professionals give a particular date. Okay, you can come on this date to India. You can go on this date from India. Then your thing will be taken care of. 182 days are taken care of. But that is a very dangerous thing to do. It is always advisable to always maintain a travel diary. It is no like complicated thing. It's just an Excel sheet we have which you have to maintain, looking at the visa and the number of stays of your client, and see when he has come to India, when he has left India, the proper travel diary, because the section says 182 or more days. So even if it is 182 days, he becomes a resident. So that is our responsibility to guide them in a rightful way. When you're doing the counseling for your NRI, it is very important to take care of the things which you should let him know what should be done when he is moving out. Some of the very simple things which you have to do is a proper KYC to be done by your client. What all bank accounts your NRI holds. So your client must be holding, when he is in India, he must be holding the bank accounts with maybe some cooperative banks, the banks which are not tech savvy, net banking is not properly available. It is your duty to guide very smoothly to your NRI client that there are several banks available which is very tech savvy and which gives proper NRI services, so that whenever they move out of India, it becomes hassle free for them, that their repatriation of funds, whatever funds they have to move from here to there, they have to open a NRO account or a NRE account. What are the positives and negatives of those accounts? What are the tax benefits? How to maintain a travel diary? These all should be part of your counseling. Apart from that, we will move in our future slides where I'll tell you the complications associated with each and every NRI client, and which differs country by country also. So those aspects to be taken into consideration on the counseling. The counseling can be a Zoom counseling, can be a one-on-one counseling, that is irrespective. Your complete knowledge and simplifying, the most important thing is the art of simplifying the most complex things is, I think, the role of us as professionals, because verbal jargons, tax jargons, or talking in a complicated language is not that complicated, because already it is available with us in the form of Income Tax Act and our laws. Where we stand for is bridging the gap between those complex acts and laws and our client who just wants to know ki, in layman language ki karna kya hai. Any client will always ask you, what am I supposed to do? You let me know that. So this should be our role when it comes to the counseling part, the initial part when we are hand-holding our client, whether be it an inbound or outbound. Why I am speaking about the inbound also? Because even the foreign delegates come to India on delegation, and there also we can play a role from a international tax or the expatriate tax perspective. So that is also one area where we play a very important role. When a person is coming from abroad, say US, UK, he's coming with a completely new mindset already to settle into a new country. So tax is something which plays a back-end role for that particular person. And if you bombard them with very complex things, it is going to be a very complex or a difficult situation for your client. So it is our role to make it very smooth and easy for them, that okay, this should be taken care of. These are the days of stay. These are the things you should maintain. This is the document, and we are there to help you in that respect. So going ahead with the taxable income for NRI. So linking it with the residential status, if a particular client or a SSC falls as a resident, ordinarily resident, then it is entire global income of that particular SSC gets taxable in India. Whatever he earns, wherever he earns, income is taxable in India. The entire global income, irrespective. Now, the second thing, for the resident, not ordinary resident, and the non-residents, the situation is different. we have Section 9 under our Income Tax Act, which talks about the taxability of accrual concept. We can say that income earned, received, and accrued in India is only taxable in India. Whatever you have earned, received, and accrued in India. So be it salary, be it business income, be it rental income, be it capital gains from Indian assets, everything it gets taxable in India when it is earned, received, and accrued in India. So accrual is the concept which you have not actually received, but it is receivable. You have raised a bill, you have provided a services in India, but the income is receivable. So it is accrued in India. So even that gets taxable in India. Now, going from simple to complex, so residential status is done, the taxability of the NRIs is done. Now the question comes that, okay, now we know that a resident, ordinary resident, his global income is taxable in India. So does that mean that the person is earned, suppose say income in US, and he's falling as a resident in India. So he will have to pay tax in India as well as in US. So then the basic law of taxation, which says that no income can be taxed twice, that cannot be crossed. That remains always as the thumb rule or the golden rule. Then what is it? So then comes the double taxation avoidance agreement in picture. So India has progressed over the years now, and today we have our double taxation avoidance agreement with approx 88 countries as of now. So the double taxation avoidance agreement is basically, in simple words, arrangement of one country with another country where you are agreeing that, okay, a particular income is taxed in both the countries, say because of some reasons, because of the residential status, then how it has to be ensured that the SSE is not facing the repercussions of it. And the SSE is getting the benefit of the foreign tax credit, FTC. There's a concept of FTC, which each and every double taxation avoidance agreement covers in some or the other clause. Either it is clause 24, either it is clause 25, 17. It is for different clauses for different countries, but it talks about the foreign tax credit. So in my tenure, I have come across like at least 30 to 40 countries we have handled and seen, and the complications differ from assignee to assignee, the income, the nature of income, the clauses which needs to be studied, but always our focus has remained that whatever best can be done in the interest of our SSE, and not only from a short-term perspective that right now we are giving the benefit and okay, the client is happy that mujhe kam tax aa raha hai bharne ko, I got the credit and all, and later on that client gets a surprise with some notice. No, our role is from a long-term association and a foolproof approach towards our client, that whatever we are doing, we are really mindful of the entire aspects from all the perspective, the disclosure which needs to be done, the foreign tax credit, the calculation, the way it needs to be done, the basis of the preparation of each and every working what we are doing. So foreign tax credit basically talks about, say a particular income, say 100 rupees you have earned in overseas country. And now because you're falling as a resident in India, it is getting taxable in India. And you've already paid tax for the same in the overseas country. So suppose 30 rupees is the tax which is payable in India, and 25 rupees you have already paid in US. So the foreign tax working has to be calculated likewise, so that only the residual amount or the balance amount of 5 has to be paid in India. So whichever is higher, because always, whenever we are understanding any law, we have to always understand that if the income tax department or the revenue authorities have created any clause, law, or section, it is in the interest of the client as well as the interest of the revenue. The income tax department or the revenue always wants to ensure that they are not at loss of revenue. So India, suppose, is eligible to receive a tax of 30 rupees from that SSC, it is not going to go against the SSC's interest also, but at the same time, it is not going to leave that 5 rupees ka residual amount. So it will be 30 and 25 already paid in the overseas, the 5 rupees you have to pay here. So it is that simple. Complications start for different reasons. For example, in US, if our financial year is April to March in India, it is January to December in US. That's where the complication starts. Now that year is broken into two. Their financial year and our financial year are different. Now there, our expertise and simplifying that particular thing comes into picture. That what we have to do, okay, what are the relevant months which are relevant to us out of those US reporting months? Okay, for me, till December, I have a data, and from Jan to March, I have it in the another return. So I have to consider the pay slips of US and match it with their tax return, see the numbers, what they have reported, the amount of tax they have paid, match it with our numbers, and look at the proportionate thing, what has to be done, how it has to be proportionately given justice to, how much amount of credit it is eligible, and accordingly see that whatever tax is paid over there, it's considered here, and the balance amount is given the credit of. Now, the compliance part of NRIs also, it is a vast area to be covered and a vast gamut to get into. But it is very interesting area as well. The more you get deeper into it, the more you will be curious to understand it ahead. So the basic compliance of income tax return filing is not at all basic like it sounds for the other individuals. It is a very big responsibility when you're taking the NRI client in your kitty, because each and every reporting, right from determining the residential status to the taxability of income to the determining factor of the foreign tax credit, what claim you're doing plays an important role. There are various complications also which in relation to TDS compliances. So TDS compliance is one common thing which comes into picture when an NRI has to sell his or her residential property in India. So normally it is like a flat 20% of the sale value of the particular property which the NRI wants to sell. But there is an option available of lower tax deduction certificate, which in which we as a professional, our expertise lies into. So the lower tax deduction certificate puts them somehow at par with the residents otherwise. So we actually have success rates where we have managed to get down that percentage of 20% to 4%, 5%, and that can be done in a very structured way, understanding each and every income, understanding all the aspects of that particular NRI, and then all the documentation to be in picture. Everything needs to be looked into, and then that benefit can be extended to that NRI. Apart from that, there are many other aspects when it comes to compliance and the TDS part also, the TDS percentage differing for different income. When it comes to royalty or technical services, it is like 10%. For dividend, it is a different rate. For capital gains, it is a different rate. For capital gains, it is like when it is a long-term capital gain on the sale of assets like equity shares or equity-oriented mutual funds, it is 10% without indexation. When it comes to other assets, majorly residential property or real estate, it is 20% without indexation, which is recently amendment which took place that any property which you sell after 23rd of July 2024, the indexation benefit will not be given. But the other things remain as it is. Apart from that, there are certain concessions which are available for the NRIs when they are returning. So At each and every stage you look into the residential status, what concession can be given to your client, and there are sections and options available where the individual, if it is transitioning from an NRI to a resident, he may retain certain tax benefits for up to 2 years. But all the aspects from the factually, each and every client is different, and all the facts has to be taken care of rather than randomly or directly applying any concession or section and putting that particular client into trouble. So it is always one thing which I've learned in my career is a conservative approach for your client. A conservative approach always saves your client, because you are always aware of the worst come worst situation which can happen, and you are aware of that particular thing ki okay ye bhi ho sakta hai. So if A happens, what is the thing which I am going to do to save my client or ensure that my client is not in trouble, how my client's journey is smooth. From a NRI perspective, if a NRI himself has to take care, the first and foremost important thing which a NRI has to do is um, this DIY thing they have to avoid in this particular situation, that okay, income tax return to bahut easy hai, you can do on this portal and that portal, but you have to consult a professional, because it is not as simple as it seems to you. When you enter into complex situation, when you are already in a soup, it is always a knee-jerk reaction which you take, which I always say that a proactive approach is always better than a knee-jerk reaction. So proactive approach is approaching a right professional. So that is the duty what each and every NRI should do, is approaching a right professional. And as a professional, it is our duty to do justice to their faith and give them the right amount of service, right kind of advice, a clear perspective of each and everything what they are looking for, because they may have n number of questions in their mind, again complicating their life by more complex things, which is not the right thing to do. It's our duty to do it as simple as possible. So going ahead to the other thing is the reporting of the foreign assets. So in the income tax return, there is a particular clause or a section which talks about the foreign assets. So all resident, ordinary resident, resident not ordinary resident, it is mandatory for them to report all the foreign assets which the NRI holds. So there are separate clauses for to be mentioned, the kind of information they have to mention, like the country name and the code where the foreign asset is there, the name of the financial institution with which the foreign assets are there, the address of the financial institution, the zip code, the account number, the status as in the status of the account as on date when you're reporting it, the account opening date, the balance during the period, the closing balance. All this information has to be given in a very structured manner, which is already available in the income tax return, that how it is to be reported, but we have to report all of that. Then comes the FEMA compliances when it comes to repatriation of funds. So before getting into the FEMA compliance, just I would like to touch base on the point of the types of accounts. So there is a normal account which that particular NRI must be holding before he moved out of India. Then there is a concept called as NRO account, and there is a concept called as NRE account. So normal account, definitely that particular NRI won't be able to hold anymore as per the law. And even the banks will inform you once they are aware about the change in the residential status. So the NRO account is for the funds which you are retaining in India. NRE account is for the funds which you are getting from out of India, in India, which you may need to repatriate back also. So to and fro of the funds can happen in NRE account and not in NRO account. The interest which we receive in NRE account is tax-free. as per Income Tax Act. But NRO account, it is taxable. So there are minor differences, but the basic purpose is that the repatriation of funds which you have to, if you want to do out of India, then NRE account is the ideal account. So many of the clients will ask this, that which account I should hold, how I should hold, can I take the money in this account, what will happen if I repatriate the funds from here. So there are several clauses in relation to that which we need to be aware of, and about the FEMA compliances which are attached to it. So there is a concept of Form 15CA and Form 16B. So Form 15CA and Form 15CB go hand in hand. 15CA is a reporting of all the repatriation of funds being done, in simple words. And 15CB is a certification which a chartered accountant does, looking at the facts of the repatriation of funds done. So it is a duty of us as professional to look into all the aspects when it comes to certifying of 15CB. So when it is applicable, whenever a non-resident is doing a repatriation of funds, that time it gets applicable. And we are giving a certification, okay, that we have looked into all the facts of the remittances, and we are okay with the nature of the remittance and all the tax implications what were applicable for the particular remittance has been taken care of, it has been adhered to, and only after that the repatriation of funds has taken place. So this entire thing is forming part of the 15CB. And the process of that is pretty much available on our income tax portal itself. So whatever points we are covering, there may be doubts, questions in relation to each and every aspect. So we can share our details where you can put up your queries on email or something, and we will take care of it, that each and every point we can try to address and reply to those aspects. So the key takeaways when we look into the NRI taxation part is first and foremost important thing is how you are simplifying the life of the NRI, be it an inbound or an outbound. Though it may be very complex in actual sense, but how you can make it as simple as possible and get into the granular level of simplification for your client, so that उनको लगे कि भाई ये बहुत simple है, और whatever is there, my CA is going to take care of it. Other thing is to make them aware about being mindful of the residential status, being mindful of the documentations to be kept in place, being mindful about the small details like the visa, the other documentations which has to be looked into. So like when I was talking about the foreign tax credit. So foreign tax credit, while filing the return, when you take the foreign tax credit, there is a separate form 67 which has to be filled first before filing the income tax return. Without that, you cannot claim the foreign tax credit. So these are all the things which you are aware of and not the client. So you have to take care. Then being aware of the DTAA norms, the Double Taxation Avoidance Agreement has several clauses where some of the incomes are even exempt. Some of the incomes are exempt for few years down the line. Some of the incomes are exempt in a particular country ka treaty. For example, Indo-US treaty has a specific clause for the teachers who are flying in from US. For a particular period, their teaching income would not be taxed. So each and every country, it's not that you will just go and jump into the foreign tax credit ka clause and apply the clause and finish it off. कि ठीक है, मेरा काम हो गया. नहीं, you have to ensure and see कि what all other aspects are there in that particular treaty, what sections can be applied, what maximum benefits can be given to the client rightfully in a conservative manner. But ऐसा नहीं होना चाहिए that we could have given him a benefit of 100 and you are giving a benefit of 70. No. At the same time, the vice versa also, that aggressive approach लेके उसको 150 का benefit देके then notice आए, then there is no point of that thing. It has to be from a long-term aspect. And most important thing is being compliant. Compliance is the key to everything. And that is where our role comes into picture, that making them aware that what they should comply for, because they do not know. They have come for their particular assignment or delegation, or they have gone out for an assignment or delegation. So our focus should be that the entire tax headache should go out of their minds, and we have to ensure that they are just focusing on their role, their job. They have come for a key management role, key personnel role, or for their business. So they have to focus on that. And this thing has to be taken care of by us in a very smooth way, so that their journey is simple. So this is about the NRI taxation part. I hope that at least I have tried to simplify and break it into different aspects when it comes to NRI taxation. There are more complexities and ocean of knowledge in relation to NRI tax, because I have spent so many years around it, which cannot be crunched in a 30-minute or a 40-minute session. But definitely, in nutshell, you can explain to give an overview of the NRI taxation aspect. Now, moving to the next, one more interesting area of today's business, or today's ball game of Indian economy when it comes to startups. It has become a very interesting area, which even our government of India and our Honorable Prime Minister also has always been promoting when it comes to startups. And why it has been so much promoted and encouraged is the talent which is lying in our country, huge talent lying in our country, which has a lot of scope ahead to explore. And we are fortunate as professionals to be a backbone for such a big cause for the development of the country. And that's why we are called as finance soldiers of our country. So this is a very good area and opportunity for us to justify our role as finance soldiers. So keep just on a lighter note, or an interesting note is, हर बड़ा business कभी startup था. Any new business or any establishment which are tycoons today, some or the other day they must have started as a startup only, no, with an idea that let's do something different. But in this era, whoever are startups are very fortunate to get such a good backing from the government, or from the income tax authorities, or from the Indian economy, that okay, go ahead, we are also there here to support you. Just come up with an innovative idea, show some courage, and there are a lot of opportunities lying ahead for you. So moving ahead, like, what are startups? So startups are some innovative ventures in different areas. It can be e-commerce, it can be industry, it can be service industry, it can be manufacturing, trading, whatever you are doing, but what value addition you are doing as a startup to the country. What is something innovative you have got up? How you have eased the life of the customers. So your what do we say is, when it comes to business, is the another person's problem should be the solution at our end. And that's what the startups are coming with, very innovative ideas, that okay, you have X problem, I have come up with this innovative Y solution, so this is my startup. So this how it got into picture. In last 1 year, there has been more than 1,20,000 startups which have come up with different ideas, and which has been honored, and incentives have been given by our government to those startups, because they have done something different than the conventional approach and whatever is already available with us. So in this dynamic environment, startups are playing a major role. So be it Oyo, or be it many different businesses which has come into picture right now. Zepto is booming like anything, coming with different areas. It first came with just grocery, then it came with wellness, then it came with accessories, then it came into Zepto Cafe. So such different startups, when we looked at Shark Tank, we were amazed to look into. But there are other areas also where we as chartered accountants, as professionals, can play a very vital role in these in this gamut of startups. And how it can be done is just looking into things that, okay, this is a piece of a pie which they have already covered. Now we have to join in and complete it. So where we can complete is then making aware of the benefits which are available to them, giving them the knowledge that how the startups which they are already doing with the innovative ideas, how they can be done in a more structured manner, how compliance, taking care of compliance can help them more. Because startups, most of the startups are done with by the techies, being initiated by the youngsters. So they feel that, or this is a headache, the tank cracks compliance is there, this is there. They're not aware about the other incentives which are available to them if they comply. So that is our duty to get into that. So startup registration, it starts with startup registration, then the compliance related to startup, then the tax incentives relation to the startups, then the tax funding and advisory when we can be a value addition for the startups. So we feel अरे startup or tax advisory or funding में हमारा क्या काम है? हमारा काम है because it is all about numbers. So starting with startup registration. So startup registration, basically it is done with the government of India. There are certain norms and clauses which needs to be taken care of. So there are certain clauses which needs to be fulfilled. So there are basic conditions, very simple conditions, that it should not have completed a period of 10 years from the inception for the incorporation. Then it is eligible for a startup. It is a private limited company or a partnership or a LLP. It has an annual turnover of less than 100 crores. It is working towards innovation, development, and improvement of any process or service. Means it is value adding in some or the other way to be eligible startup. So eligible startup is the first requirement to be falling into the incentive basket of the taxation. So there are very tax planning strategies available for the startups, like tax holiday under 80IAC. It is basically that if you are an eligible startup, you are eligible to get a tax benefit for 3 years out of the 10 consecutive years. So 3 consecutive years out of the 10 years, you are eligible to get a tax holiday. So whatever profit you generate, that will be tax-free. This is just to promote the economic growth, to promote the startups. This is the initiative taken by the government. Then there is a angel tax exemption available, which is under section 56 to 7 of the Income Tax Act. So in very simple terms, or a layman terms to say, when an angel investor is investing in a startup, whatever premium that particular angel investor owns, that can be exempted from tax under this section. Of course, considering certain clauses which are applicable in that particular thing. Then there is a section which relation to research and development, R&D, section 35 of the Income Tax Act. So if there is a research and development taken place, so that research and development, especially when it comes to any scientific research, any chemical, pharmaceutical industry, such kind of vital roles which can completely revolutionize the entire nation's picture to 360 degree, then it has to be honored or awarded with something great. So the startups which are involved in research and development can claim a deduction for the expenditure, which can go up to 150% of the incurred expense. So suppose you have incurred 100 rupees, you can claim 150% 50% of that as an expense, because it is an additional incentive which is given to you just because you went that extra mile for the betterment of the country, did something for the development of the country, did some research and development, because that is the future of any country. So that has to be supported in that manner. Then there are some capital gain exemptions which are available, which is 54GB and 54EE. So 54GB is particularly a section which is for an individual who has sold some property or something and he has gained some capital gain. And suppose in that particular year, that person happens to be an angel investor or investing in a particular startup, then he can get benefit of that particular investment under section 54GB. So suppose he has gained a capital gain of say 100 rupees, and that particular person invested in a particular startup, eligible startup of say 60 rupees. So he can get a benefit of 54GB and get a benefit of that, and only 40 will be taxable. Suppose he invests the entire 100, then there will be nothing taxable for that particular individual. There is another section which is 54EE, which is available for the startups. So if the startup, particular startup, the eligible startup, invest in particular funds which are notified for the startups that, okay, these startups can invest in this fund, which will be essentially something related to government funds. The government basically wants that your surplus you invest for some government funds, then you will get exemption from your long-term capital gain, whatever you have earned. Suppose a particular startup has sold some property or some asset which was eligible or liable to capital gain tax. So they can get benefit of this particular section if they invest some amount in some specified funds which are notified for the eligible startups. Now, the most important thing where we can play a very important role is awareness. The most important thing what the startups need to be made aware of, that what you think is very complex or not achievable, yeah, it is a headache, why I should do this, why I should get into this compliance, मुझे ये भी register करना है, मुझे GST भी करना पड़ेगा, मुझे ये भी apply होगा, ये सब क्यों करेंगे हम? So you have to make them aware that what can happen if you do not do this. If you don't comply with this, it will be actual headache for you. And doing all these compliance can be made simple for you because we are there as a professional for you to help you for that. So the common mistakes which the startups do, कि ठीक है बाद में जब business बढ़ेगा, that time we will take care of it. अभी नया बिजनेस शुरू हुआ है ना, अभी क्यों रजिस्टर करना है? Why you want to take the GST registration? Why you want to do startup registration? What is the point of maintaining the accounts? Why we should do? अभी टैक्स पेमेंट करने का क्या जरूरत है? Let's see later on when we have surplus funds, that time we will adjust. We will look into the penalty and interest, whatever is there later on. Then the personal finances and the business finances, they will mix it into with each other. They will not have clarity how to segregate those. So there are several things which they do because of ignorance, and then negligence comes into picture because of the ignorance. So it is our role to make their life simpler, jot down the points for them, create awareness for them, have regular meetings and sessions with your startup clients, boost their morale, because always remember, like I said, that हर बड़ा business भी कभी startup था. So when you look into them as a prospective big giant, then only will their caliber also be boosted, and you are boosting their morale as a client by simplifying their life, by making them making aware of the each and every aspect, that how you can play a role in this. Like I told you that apart from the tax compliance thing, you can even play a role in the advisory when it comes to funding also, as a finance personnel, with considering everything in mind, like giving them a realistic picture, not inflating anything or giving them a rosy picture, but at the same time hand-holding them in their journey when it comes to taxation as well as the funding, when about the dealing with the investor, the finance part also, we can deep dive into, give them the business advisory perspective of ours, because uh, we have a very multi-dimensional role when it comes to being a professional chartered accountant. We hold a membership number not only to take care of the compliance part, but be a complete, a kind of partner with them when it comes to your clients. You have to own the thing that, okay, were it my business, what I would have done, advising them likewise, keeping in mind all the code of ethics and all the norms which we have to respect as a professionals, but at the same time helping them out with giving them an overview of the industry, what is going on in the industry, what are the best practices, what are happening in the industry, uh, how in the funding role, or there are so many kinds of funding which are going on, like some startups start with the bootstrapping, some will go with seed funding, some go with angel investors. For everyone, the tax compliance will remain more or less the same. So we are the constant. So when we are with them, it is our role to always correlate one thing with another. Never look into each thing as silos. कि अरे मेरा तो यही पार्ट है ना, मुझे सिर्फ टैक्स का ही पता है, मैं तो इतना ही बताऊंगा, फिर बाद में तुम बिजनेस का जो करना है करो. It's not like that. Each thing is linked to one another, and it is our role to join the dots one with another and simplify life for our clients. Make them aware of each and every aspect, that how reporting of the income and expenses in a structured manner can simplify your life, because at every stage you know where you stand. Okay, you are at a break even, you're not at a break even, what expenses on the, many people I have seen, many chartered accountants do the accounting at the end of the year, give the income tax return, file it, finish it off. But what I see as accounting is a very big responsibility, that you are actually hand holding them into their business. You are part of the business. It's a very big role, because you have to raise a red flag to them. Like, okay, the expenses, this particular expenses is going on a higher side, which can be avoided. These marketing expenses are going on a higher side. This can be avoided. Okay, you have to, your sales are not at par, so we can increase the marketing expenses to some extent. These all value additions can be done when you are looking after the accounting part of your clients. The client will be really amazed to see that, oh, I had never expected that this can be the quality of the accounting services also, and not just look into any professional as just like, okay, I have met many chartered accountants and I know you just file returns. No, we have to raise the bar, and that is our responsibility to raise the bar as a professional. That okay, we can do whatever you have not even thought of. That kind of quality of services can be provided by us. You have to just have faith in us as a professional. So this is it. The takeaways, as in case of the startup advisory, I can say that awareness of a compliance and tax benefits is very crucial. As a consultant, giving a right knowledge and services to your clients is very important. Startups need support right from the inception. Each professional, it's our duty to live by it, that it is our duty to handhold our the startup from the start. Startups of the future of our nation, and we are very fortunate to work with the startups, because we are somewhere contributing to the country's future and the development by supporting those startups in any manner. In any manner, we have to just make utilize our knowledge and do justice to whatever services and role we are playing. So this is it. Thank you from my side, and that's it.
Hello, ma'am.
Hello.
Hello. There are few questions.
Okay.
The first question is, what are the effect of tax in case of NRE has got the property and money on the death of his son in USA?
Okay. So you want these questions to be answered right now, or it can be taken offline? Because these are very complex questions which you are asking, which has to be factually understood
Okay,
first.
it would be as per your. If you feel that we can discuss that offline, we will take it as it.
Yeah, I would prefer to take the questions offline because giving just an answer for the namesake won't do justice. It has to be understood fact-wise. I'm okay sharing my contact details, my email ID, and it is open forum. Like anyone can put in their queries, and I'll make it a point that those are responded and replied to.
Okay. Thank you, C.A. Sushila Madam, for starting a program on such high note. Your insightful thoughts on startup initiative have set the perfect high tone for today's event. We truly appreciate your depth of knowledge and expertise you have shared with us regarding NRI taxation.
Thank you.
Your
My
contribution
pleasure.
your contribution has provided us with a great foundation as we move forward to our agenda. Once again, thank you for your valuable time and effort.
Thank you so much. It was a pleasure. Thank you.
Now I would like to welcome our next speaker, CA Pooja Patani, to continue this enlightening journey. Pooja, madam.
Yeah, yeah. First of all, I would really like to thank Sushila Thakur ma'am for giving such good insight in regard to that. And with that only, I will try to introduce our next speaker, ma'am Shika Sood, who Miss Shika Sood is a chartered accountant and a CFA charter holder, and she has like 14 years of experience in financial strategy and also product development. And she currently actually leads in product strategy and innovation at Edelweiss Asset Management Company with a focus mostly into equity, debt, and hybrid schemes. So I would really like to invite her and would like her to, go ahead with the session.
Yeah, thank you. Thank you very much, Pooja, and a very warm welcome to all of you. So I know you'll have had a great first session of the day, but luckily this is a very different session from what you've experienced. So you've got a great sense from a taxation perspective in the previous one. This is about mutual fund portfolios. Now, mutual fund portfolios as such are, so it's a very, very wide topic, just like how taxation is. Which is why I say just focusing on, say, NRI taxation piece in one session would make sense. So similarly, but however, what I've tried to do is I have tried to just make this presentation more focused on a little bit of basics of mutual fund portfolios, the different categories of mutual fund, and this probably then can help you also go ahead and create your own portfolios. So I'm just going to, before we start, I would just like to take a quick poll. Just allow me a minute. Sorry, there is some technical prompt on my screen. On my screen, it says somebody's requesting remote control of my screen. Somebody, I'll make it full screen. Yeah. Yeah, that's good. Okay. Okay, great. Thanks. So, who, according to you in your life, manages money the best? So I just want you to quickly go on to menti.com. You can do it from your laptop, you can do it from your phone, and enter this code that you can see in front of you. This is going to be a very quick poll. So it can be anyone. You would have probably come across your father, your boss, a very good friend of yours, can be your mother, whoever according to you, that you idolize in a way of managing money the best. So I'm going to give you a minute. So you can just have to go to menti.com and enter the code that you can see in front of you. So just to give you a sense, so some of the responses that I'm looking at and that also I've received in the past are typically the ones also that I have mentioned. So, you always have probably one person in your life, say typically it has been either your father or your brother. And in fact, for a lot of us, whoever is married here on the group, even it has to be with your husbands. So while we are chartered accountants ourselves, and very well qualified. We know our stuff really well. Irrespective of that, sometimes we tend to take a back step or a back seat where this is concerned, where managing your own money is concerned. So therefore, this is just, this poll was just to, tickle your brain a little to really figure out that do you see yourself as well as somebody you idolize in terms of managing your own money. So what I really intend to do at the end of this session is that I would like all of you to take away one point, that you really need to take charge of your own finances. And the other thing that can help you probably do that also to start off with is that you can ask the right question. So this is going to be your key takeaway out of this session. So what do you think really this means that you can see on your screen right now? So essentially, what I'm trying to do here is that before you even get into the step of creating your own portfolio, you have to first test your strength of your heart. How much volatility, uncertainty in the markets can you actually stomach? And something that really gives you a good night's sleep is what an ideal portfolio is going to be. So which also means that an ideal portfolio for you would be very different from a portfolio for somebody else, for your sister, for your colleague, for your parents, for another friend. So therefore, it's very important that you, before you start building your own mutual fund portfolio or any investment portfolio, it is very important for you to assess for yourself how much risk can you take in, how much volatility or uncertainty in the market would you be able to bear, and whether you would be able to stay through course and stay through the entire journey of your investment. Now, just coming on to mutual fund products. So what is available, the suite that is available in the market. So you have, so this, what you can see in front of you is a classic risk return matrix. And right at the left bottom is basically, it means that lesser returns with lesser risk. So as it goes up on the far right side, you can see equity funds, which means that for higher level of risk, you can expect a higher return. Now, this is something typical of the market, right? So the higher the risk you want to, the higher the risk you take, you would expect a higher reward, right? So that's the risk reward ratio. And hybrid funds are right in the middle. They give you a flavor of both debt investments, debt securities, as well as equity. Now, what really happens is that debt funds would be 100% debt investment. On the other side, equity funds are going to be 100% equity investments. And what hybrid funds do is there are, again, various scheme categories available within hybrid. They give you an equity and debt exposure of different proportions. So, for example, equity in one fund would be, say, 65% and debt would be 35%. In other exposure, they would like to give you a 40% debt with 60% equity. So there are different types of products available basis your requirement, your need. Now, I don't mean to overwhelm anyone here who have joined us, but this is what largely it looks like in terms of categorization. Now, SEBI, who is the regulator for mutual funds, has defined certain categories. For example, in equity, they are largely market cap based. I'm going to get into details of each of these categories in the slides to follow. But so say, for example, you would have heard of large cap companies, which are larger companies. Mid would be the in the mid range, and then there will be smaller companies. So that is called as market cap wise split that has been provided for categories. There are sector specific funds. There are, for example, you have IT, you have, say, pharma fund. Thematic would be, say, a business cycle fund, or some other similar theme-based opportunities, also manufacturing. And similarly, there are other categories like value, contra, and ELSS is something that most of us would be aware here. For the ATC benefit, a lot of us would have probably subscribed to it. Debt, again, would have basis the duration that you want to invest, whether it is 1 month, it is 6 months, 1 year, 3 years, 5 years, issuer based and strategy based. So I'll get into details of this later. Similarly, you have basis your different levels of equity and debt allocation. You would have forms starting from conservative hybrid right up to, say, an aggressive hybrid fund, and a lot of the other funds in the middle to manage your equity and debt allocation that you would want. There are certain solution-oriented funds as well available, and then there are passive indices of passive funds, which are index or ETFs, and also there is some exposure that you can take by investing in your Indian mutual funds to international stocks. Now, starting with equity scheme categorization, the most basic one of this is going to be by market cap. And this is to start with now large cap. This is something that has been defined by regulations for us in the mutual fund industry, that if you have to rank all the stocks that are available or that are listed in the Indian space, if you have to rank them by their market capitalization, then the first 100 would be called large cap. The next 101 to 250 would be called mid cap, and then 251st onwards companies would be small cap companies. And there are certain rules involved that if you have a large cap fund, what would that mean? That would mean that at least 80% of your funds that you collect from investors would have to go into the large cap fund, or sorry, into the large cap stocks. And you do have 20% leeway that you can invest into a mid cap stocks or small cap stocks, or you can, of course, go further and say decide to invest 100% of the portfolio into large cap. For mid cap, the rule is a little different because the risk level also goes up. So what they suggest is that minimum 65%, the green color that you can see on the screen, 65% you have to stay invested in mid cap stocks. And then the remaining 35% you can stay invested in the lighter blue or the darker blue, which is your large cap or your small cap stocks. Then comes your small cap funds. Similar to mid cap, you have to, there is 65% at a minimum would be invested into small cap stocks, and rest you can invest into a large or mid cap. Now, if any of you have already started investing into mutual funds, you would have realized that if you look at the portfolio, a large cap fund would have some exposure to mid and small. And similarly, mid-cap funds would have some exposure to large and small as well. And then small would have some exposure to large and mid-cap stocks. Now, nobody is trying to trick anybody here. But yeah, so earlier, before this categorization really came in, there could be a possibility that a fund is trying to call itself, say, a mid-cap, but would be largely mid-cap fund, say 50, 55%, or even 60%, but would have significant continuous exposure even to other type of stocks. So therefore, this categorization came in. And since then, they've told that, okay, these are the limits that we have prescribed for you, 80, 65, 65. And the balance you can decide and go ahead in any other stocks. But in minimum, you will find exposure as to what you can see on your screen right now. Similarly, there are large and mid-cap funds which say that for large cap and mid cap, minimum 35% would be invested, and rest you can invest in any, basically you can take a call whether you want to go overweight large cap stocks or mid cap stocks or take that exposure into small caps. It's completely up to the fund manager. And that is why, we need experienced fund managers deciding and picking stocks from different market caps. You have multi-cap. In multi-cap, the requirement is a minimum 25% has to be invested into large cap, into mid cap, and into small cap stocks. That is the minimum requirement. Next, if you see on your screen, sorry, just give me a minute. Yeah, next is Flexi Cap fund, which essentially has no restriction. You can invest, the fund manager can invest across mid, small, or large cap into a proportion, into any proportion that they like. So if you want strict allocation to minimum allocation to large, mid, and small, then multi-cap fund is something for you. If there is, you would like the fund manager to move across different types of funds, different types of market caps and flexi cap category. So just to summarize, these are just market cap based funds that are available in the market, which are large cap, your larger companies, mid-sized companies, smaller companies. You have a combination of large and mid, you have multi, you have flexi. Like we saw in the previous slide, there are other categories also, but let's just focus on the base ones that you can see in front of you. So basis your risk appetite, of course, as you go towards from large to small cap would essentially mean that you are willing to take a higher risk for your portfolio, but that also means that you can relatively expect relatively higher returns is what you can expect for the additional risk that you're willing to take. But of course, this also means that in general, the investment horizon that somebody should target for staying invested in equity funds is 3 to 5 years. I would say for even riskier funds, you should look at maybe 5 years and above for investment, because the price can really move up and down quite frequently, and that can really make you a little nervous if you're not used to taking that level of risk in with your investments. Now coming to hybrid. So hybrid, I'd probably try and keep this relatively short, though there are several categories that you would see on your screen in a minute. But essentially how this category works is, like I was saying in the previous slides, that you have your equity allocation and you have your debt allocation. And there are different categories of hybrid funds available. Basis how much allocation do you need into your portfolio of, say, equity and debt. So they are essentially a mix of two asset classes. So starting with the basic, which has the least exposure to equity, and this is the conservative hybrid. It has 75 to 90% as per rule. So these are all SEBI rules. These are ranges, and your actual funds can have different exposures. So debt 75 to 90, equity would be 10 to 25%. Balanced hybrid is 40 to 60%, either in equity or debt. Aggressive hybrid is 65 to 80% equity. It's called really aggressive because of its higher exposure to equity. And debt would be 20 to 35%. This one category, we've seen a lot of significant traction in the industry in this one particular category, which is dynamic asset allocation or balanced advantage, as they would go by their name as well, is that the fund manager can decide to go from 0% allocation to equity right up to 100% or even vice versa, and have allocations that much to debt. Now, this is a very interesting category, and each fund house manages this very differently. Some fund houses would decide that if the markets fall below a certain level, that means they've gotten a little cheaper. So therefore, we would further go ahead and invest a little more into equities, and they would increase their allocation to equities. On the other hand, there would be certain fund houses which say that no, the valuation has fallen. Probably it would continue to go down. Therefore, this is time for me to reduce my equity allocation to avoid any further downfall or negative impact on my portfolio. So there are different kinds of strategies available in this particular strategy as well. And equity savings, this would probably give you more like a debt plus kind of a return with equity taxation. So while you can see on your screen there are 10 to 35% into debt, and equity 65 to 90%. Typically, the risk of this category is relatively less. How this really functions is, you would have your cash or direct stock investments up to, say, 25-30%. Now, each fund house can manage it differently. But say, for example, you have 25 to 30% of this 65% that you can see on your screen into under equity savings. You would have that into pure cash exposure. to stocks, and balance is what you would do an arbitrage, or futures is what essentially you can enter into to mitigate that risk. So you would earn like an arbitrage sort of a return. You would the cash future arbitrage. So that is almost like a debt plus kind of a return, debt or equivalent kind of a return. So therefore, we call this like a debt plus category, but with equity taxation, because as taxation rules go, and most of us would be aware that equity taxation would mean that your fund should be investing, the underlying investing into stocks should be at least 65%. So if 65% of your stocks are invested, if your fund is invested 65% into equity, that means this particular fund is going to attract equity taxation. There are two other interesting categories which are not very, which cannot be very aggressive. One is the multi-asset allocation fund. Now here again, different fund houses have different ways of managing this. This essentially gives you exposure to 3 asset classes, which is your equity, debt, and commodities. By commodities, I mean essentially this would be your gold and silver. And however, there would be a certain, so that is a clear exposure. Directional movements of the equity goes up or debt goes up, or say your commodities go up or down. So that is what you can expect return out of your multi-asset allocation fund. There would be certain strategies which are not really taking directional exposure. They are taking sort of an arbitrage exposure into these into the underlying securities, and therefore you would expect again little probably around debt or debt plus kind of returns. Arbitrage is what largely, so this can probably take, so while I am speaking of cash future arbitrage, these terms, while these can sound a little daunting, but we can probably get into details if required later on in the Q&A session, or probably we can also organize this whole separate session to understand some of these strategies that I'm referring to. Arbitrage is just cash futures. So you buy a stock into the cash market and you probably sell it in the futures market. So then you lock a specific return. The price difference that you realize between buying a stock in one market and selling in the other market, you'd lock a specific return. That is essentially the return that you're going to get out of an arbitrage fund. And this arbitrage you can run on. So this particular arbitrage fund would run these cash future trades for equities. But yeah, in general, there are certain categories under mutual fund which would allow you to run this even on commodities like gold and silver. Debt scheme categorization, coming to another section. Now, this is basically divided into 3 parts. One would be depending on the maturity of the underlying securities. And when I say maturities of the underlying securities, this also means that this helps you to also map your need for that fund, which means that, say, for example, a fund would be investing in underlying securities which have a maturity of 1 year. Typically, if you have a requirement of money, say after 1 year, you would want to say prefer that fund. So then therefore you can expect the debt kind of debt returns, and if you stay invested for that stated period. Now, there are several funds available. Most of institutions and treasuries and larger sum, a lot of them would be investing into overnight. This is basically less than 1 day maturity. Liquid would have less than 91 days. So it would invest in only papers or debt securities up to 91 days. There is a category of ultra short duration, which is 3 to 6 months. Low duration would be investing into securities, underlying securities, which have a maturity of 6 to 12 months. Money market up to 1 year. Short duration 1 to 3 years. Medium duration 3 to 4 years. Medium to long 4 to 7 years. And long duration more than 7 years. Now, one important aspect is that so we've learned this earlier, and just still I would like to a little bit touch upon it. As you move down this particular ladder that you see in front of you, your risk increases. Also, basically, if you remember that the longer the duration of your portfolio, the higher the interest rate risk, right? So if RBI decides to move around the interest rates in the coming months, that can have a larger impact on a longer duration. longer duration funds. So depending on what the interest rate cycle is, what the current yields or yields are of different securities and different funds, a decision is basically taken on which around which scheme category should you be investing in, mapping with your investment horizon, or for how long can you stay invested into this particular fund. So these are slightly nuanced, I would say, because we have seen in the past that for certain debt securities or for debt mutual funds, somehow when people just try to go ahead and invest by themselves, there can be periods where one particular debt security would be giving you like an equity like return because of the interest rate movements, and but that is not something that is going to be sustainable, and you would quickly even see probably that return coming down. So therefore it's always helpful if you understand and learn these concepts in detail and understand the impact of the macro scenario on your funds before you decide to actually go ahead and invest in these. And of course, there are mutual fund advisors also available, mutual fund advisors and distributors who can basically guide you through this process of investing. So there are specific exposures also. There are certain type of people who only want to invest in corporates, who are only maybe looking at exposure into bonds issued by the banking sector or the PSU sector, or just focusing on government securities. So those kind of funds are also available. Now, there are certain other strategy, and probably, I'll just list the names down, won't go into too much detail at this stage. It's basically dynamic bond fund. So like you saw on the left-hand side of the screen, that specific fund categories have very defined duration. So you can buy and sell securities within those specified duration or maturity buckets only. Dynamic bond fund, there is no such limit. So you can move across all maturities, depending on the fund manager's view on interest rates largely. Credit risk would mean, so typically a lot of fund houses or some select fund houses would take a call that they would invest only in AAA rated papers. So there are rating agencies and they rate these bonds or securities issued by organizations. So someone would say that, no, I want to invest in, say, below AA or AA plus securities. So anyone who's taking a higher credit risk, which is a lower rating, can probably go ahead and launch a credit risk fund. And if you're looking at taking a higher risk, you can invest in a credit risk fund. But so like I said, so here what would really happen is the lower you go in terms of rating, the higher the risk, of course. So that is something you need to be aware of if you're looking from a risk reward ratio perspective. There is another floater fund and a gilt fund with 10-year constant maturity. Now, coming to a very important point that some of us would have seen, that there is a constant debate that there is something called as active funds, there's something called as passive funds. So just an example in front of you, I would like to give. On the left-hand side, you can see, so this is basically, imagine yourself traveling from home to your work location, or for that matter anyway, from home to your friend's house or to drop your child to school. Now, there are different modes of transportation that you would prefer. Now, on the left-hand side, you can see probably you are driving your car, right? So what really happens here is you have control over what time do you want to leave. And so therefore, that's when you would get into the car. You would have a broad sense on what time you want to reach, what the traffic condition would be. There would be various parameters that you would consider, and then you would go ahead and drive the car. You can manage the speed by yourself. So this is probably, you can think of an active way of reaching your destination. On the other side, you would probably decide that, this is one destination. You don't want to take any decision. You just on which route to take. There is a pre-decided route. There's a pre-decided route. And all you have to do is just go sit and trust that the driver, the rules, the location, what is mapped, the train, for example, the train or the metro is going to take you to that destination. So that becomes your passive passive way of traveling. So this is exactly, if I use this analogy in investing, the left hand side where you have control, you give the control of managing your investments to a fund manager. So when you come to a fund house or an asset management company, and you ask for an active fund, is essentially that you are going to trust your money with a fund manager who has relevant experience, who also has a certain strong team and a strong research base in the fund house itself, and they would decide that basic what the market condition is and what the financials of stocks look like. They would go ahead and decide, okay, whether they want to invest in a particular stock or they don't want to invest. There's a lot of research, there is a lot of expertise required in active management. And in India, the kind of market that India is, sorry, so the kind of market that India is, there is scope of alpha across different market segments. So versus you would see that probably in the US, there would be more inclination towards, say, index or ETFs. But having said that, but yeah, there is alpha even available over there in certain pockets. So therefore, for that additional alpha, or for that expected or relatively higher return, which is why there would be a slightly higher fee also that would be charged in an active offering. Passive is very rule based. So say, for example, a Nifty 50 market that you would say that the Nifty has gone up, gone down, sections that you hear day in and day out in terms of markets. So that is nothing but an index. So when I decide that I want to invest in Nifty 50, would mean that I'm investing into that index or that ETF, which is a passive offering. And that basically Nifty 50 would have a certain rule that the top 50 companies by market capitalization, and these stocks would only change once in 6 months, for example, basis their change in market capitalization. So it is a very well-defined rule. There is no intervention of the fund manager. When the index is launched, before that itself, there is a discussion held with a lot of AMCs, and then we decide that, okay, this rule works, and therefore then that index is set. And anyone who wants to launch a fund, a mutual fund, is how you can invest in that particular index, right? You cannot just approach a Nifty, NSE, or a BSE and say, I want to invest in your Nifty 50. You would really have to buy that individual stock, those 50 stocks, into a portfolio, which can be a tedious process. So therefore, the route or the investment, the vehicle that is available for you to invest into a Nifty or a Sensex is the passive offering. So therefore, you have two options: an active fund with relatively higher level of expertise, and a passive offering. Now, because passive funds are rule-based with minimal intervention or no intervention by the fund manager is the key role of the fund manager here is that there are 50 stocks in stated proportions. The fund manager only has to go and deploy whatever money is received in that same proportion into for that fulfilling the objective of that specific index. So therefore, there is a expense ratio difference between active and passive funds. So just to give you a sense on different types of hybrid funds. Now, I spoke of aggressive hybrid, and I spoke of also balanced advantage fund or dynamic asset allocation fund when I was taking you through the hybrid set of categories. Now, this particular slide, I'm going to spend some time here to give you a sense on how do you understand further. So this is just as illustration. I have picked aggressive hybrid and balanced advantage fund to give you a sense on what really happens within them in terms of their portfolio composition, the tentative returns that we've seen in the past, and also the suitability of this particular fund. Now, this probably somebody who's looking for growth in their investments. They have a relatively higher investment horizon, and because this fund has higher allocation to equity and some allocation to debt for stability. So as you can see, the minimum allocation to equity is 65%, and the maximum can go up to 80%. In debt, 20%, and maximum can go up to 35%. In equity, what we have seen typically now, going a step. So the one layer that we have to understand is that aggressive hybrid fund, it's a hybrid fund category. So therefore, it will have a mix of equity and debt. The ranges are defined by the regulator. So therefore 65 to 80 and 20 to 35. That is the kind of portfolio composition that you can expect. Then when you get into equity, now when you are analyzing the fund by yourself, or if you reach out to a person who is managing this fund for managing a portfolio, these are some of the guiding points also that will help you better understand how your money is invested. Now, within equity also, typically we have seen that the most funds would be invested, say, across market caps. That is broadly the market cap split. Largely, we've seen that about 50% would be invested into large cap stocks and balance in mid and small cap stocks. So the whole funda of having a hybrid fund. So typically, if you wanted a higher exposure to equity, you're willing to take that higher level of risk, then you can just directly go and invest into equity, right? So why do we have hybrid funds? We have hybrid because somebody who wants equity exposure but doesn't want too much volatility, because so that lesser volatility or relatively higher stability is gotten by the debt component of the portfolio. So which is why you wouldn't want to take higher risk and be very highly invested into mid and small. However, sorry. However, this is really at the discretion of the fund manager, or basis where he sees that pocket of opportunity. Similarly, for debt, again, so I spoke of that there are different credit ratings of different bonds. Also, you have securities of different maturities. And these two are very important aspects of any debt investment, right? So you would decide, if a corporate would decide that I want a debt for, say, 3-year period, and they would go to a rating agency and say, I want to get rated. So after evaluating various criteria, say, for example, it gets a AAA rating. That would mean that the investment is of a very higher grade, higher rating, and the probability of a default would be relatively lesser to someone, say, who's given a BBB rating, right? So since a hybrid category is meant to give you relative stability, you would see that mostly the debt security exposure here is taken into AAA rated bonds or into sovereign, that is your government securities. So therefore, the risk level is going to be relatively low. So here what you can see is, there are, how do you look at returns? Now, a lot of, you would see that a lot of websites when you go to, they would show you 1 year, 3 year, 5 year, 10-year returns. That is nothing but, say, as on 31st of December, what is the last 1 year return? So say if you would have invested as on the 31st of December 2023, and you would have stayed invested up to 31st December 2024. That is a 1 year investment period. That is the 1 year return. Similarly, you would have 3 year, 5 year, and 10 year. Now, while you do see those kind of returns, what really happens is to analyze a fund or to analyze an investment, it can become a little tricky because here your returns are really dependent on the entry and exit point. Also, you're looking at only probably 1 year or one market cycle. So, which is why a better way to analyze funds can be looking at rolling returns. Now, what I mean by rolling returns is that, say, because this is an aggressive hybrid fund, I have example of 3 year and 5 year return. Now, this is not 3 year return, last 3 year return only. This will be last 3 year returns if somebody would have invested 3 years ago, exactly 3 years ago, but also on various other time horizons. What this means is that you look at 3 year returns on different periods. So you don't look at 3 year returns on just, say, as on 31st of December 2024. You would look at 30th November 2024, what the 3 year return would have been. You would look at that on 31st October, on 30th September. And that's how you would then compute an average of these 3 year returns. So there are several 3 year return observations that you have in front of you. You can probably take an average. You can look at the minimum 3 year return, maximum 3 year return. So that would give you a sense that, because if you want to negate the impact of market timing, Since the market scenario that existed in the past may not exist the same when you decide to invest in this fund, it is best to average out all 3-year returns in the past of the fund and then see roughly what is the minimum, what is the maximum, what is the drawdown, or how much has been the fall from the peak of the fund. So there are a lot of analysis that you can do. This also shows consistency of return. So therefore, rolling returns is something that you should prefer. There are a lot of websites that have started providing that now. Which is along with your trailing, which is pure 1-year return, they would start showing you rolling returns or returns over average returns for a longer period. Typically, an aggressive hybrid fund would give you about 13.5% returns. About 80% of the times is what we have noticed. A 3-year return, a 5-year return specific. Also, about for 85% of the times in the history of the aggressive hybrid category, about 11 or 12 odd percent is what this has given. So this is basically we have taken 5-year returns over the last 10-year investment horizon, 10-year investment period. So basically, what this also means is that at the bottom you can see that we looked at typically how many times has this particular category given greater than 9% return if you had invested for a period of 3-year or for a 5-year period. Now, 9% returns is typically 80 and 85% of the times between 3 and 5-year. This is suitable for somebody who's looking for relatively potential higher returns because they have higher allocation to equity and some allocation to debt. Taxation, since it has minimum allocation to 65 that you can see on your screen, is going to be equity taxation. So just being cognizant of the time, just quickly, similarly, I've taken another example and we'll move quickly with this, is the dynamic asset allocation or balanced advantage fund. So here you can see that there is no minimum or basically you can move across any range from equity to debt. In aggressive hybrid, you saw there was a fixed range. Here there is no such range. The fund manager can decide based on the market condition whether they want to go 100% into equity or 50% or 60%. And typically the equity allocation, what we see is majority into large cap with some exposure to mid and small, the same logic that you would want to give a relatively stable portfolio. And debt is again high quality with majority invested in AAA rated corporate bonds or sovereign. Here, what we've noticed is that the average returns or the rolling returns over, say you had to stay invested for 3 years, has been about 11%. And the 5-year return has been about 10.5% returns. On an average, this is what this category has provided. And then we did another analysis that how many number of times has the 3-year and 5-year return being greater than 8%. So 80% of the times, this particular category has given greater than 8% returns. And 75% of the times, it has given greater than 5-year return greater than 8%. But note the above numbers are the average, which is the rolling average of the rolling returns. This is basically somebody who doesn't know whether they should, how much equity or debt allocation should they have across in different time periods. And they would really want to outsource this job of deciding equity and debt allocation to a professional. So that's when you enter into a balanced advantage or dynamic asset allocation fund. So then you have a fund manager who's doing the decision making for you, whether equity should be higher or debt should be higher, depending on the market scenario. This again, because of minimum 65%, if it has minimum 65%, this would be classified as an equity taxation. Now, how do you really, if you have to construct your own portfolio, how do you really decide the allocation between equity and debt? So there are a lot of thumb rules that are given to us. That is, for example, 100 minus your current age should be your equity allocation. That is, if you are 40 years of age, 60% should be your equity allocation. If you're 50 years of age, 50% should be your equity allocation. Or somebody follows 60-40 rules, that is 60% equity, 40 debt, or 50-50. But while there are rules available to guide us, this is really one very important factor that I spoke of also right in the beginning is what is your really risk appetite and what your existing wealth and your investments are with you currently. So there are a lot of other dynamics that play into it. So whenever you read any such articles, there is something called as FIRE also that will probably guiding you to retire early. but there are several dynamics. So don't go by any one specific rules. You have to look at your life holistically. And who are your dependents? What is your current allocation to equity? Or do you have a very large allocation? Say you bought a house, you have a very high fixed allocation and not very liquid. From a liquidity perspective also, you have to see. So there are several things that would get involved into deciding. And this is really going to be your step one when you start building or when you start evaluating your investment portfolio. That is, what is the allocation between different asset classes, be it debt, equities, what we've spoken of, but also extending to, say, a real estate or, say, a fixed deposit or to any other investment category available. So just some illustrations on some portfolios that I've come up with that you can see on your screen right now. But this is only to give you a sense that what kind of how a portfolio typically can look like. Now, the one that you see in front of you is basically the combination of an index fund and the balance advantage fund that I just spoke of a little while earlier. And say somebody wants to even start an SIP. Now, SIP is something that we would have heard of a lot in the market. It is nothing but, somebody would decide to go ahead and invest 1 lakh or 10 lakh or 50,000 straight away into the market, and that's it. They would just shut it and forget it, say, and that's about it. That's the one-time investment they would make. An SIP is a systematic investment plan. That would mean that every month you decide that 10,000, 10,000, 10,000 every single month is what you would be investing, right? So say in Jan 10,000, Feb 10,000, and you would consistently keep investing into a particular strategy. So SIP is also can be considered into this or to any other combination that I'm speaking of right now. So the first one is the Nifty Large and Mid Cap 250 index fund is something that you can consider with a 50% allocation. What this does is, I spoke of market caps, right? So this looks at the top 150 large cap stocks. Large caps are your top 100 stocks by market capitalization. Mid cap is next 150 stocks. So roughly exposure to 250 stocks, and this can really be considered as a core allocation to in your portfolio. The other is a balanced advantage fund, which manages the equity and debt allocation dynamically, and it aims really to provide you equity-like returns with relatively lesser uncertainty because of its debt exposure. So a 50-50 allocation is what probably you can consider. So you have a core equity fund, but this is a passive fund, so this would even come at a lesser cost. Equity active can go up to 2.25%. Of index fund investment can be up to 1%. So therefore, the cost is relatively less for the reasons that I discussed a little while earlier. And then you also, but the balance advantage fund here I've suggested is the active fund because it's deciding on the asset allocation and also the underlying securities between equity and debt. The other one, if someone is interested in investing across equity, debt, and commodities like gold and silver, there are opportunities available here. So say I stick to the same core fund that I spoke of in the previous slide, which is a Nifty Large Mid Cap 250 Index Fund. That is a passive equity fund. You can probably still continue to give 50% allocation because you want that equity upside, and you want some allocation to commodities like gold and silver. And so there is an FOF also available in the market. By fund of fund, I mean that it would invest 50% into gold and 50% into silver. It will give you an about equal allocation to gold and silver. That is something you can consider up to 25%. And there is either this, there are index funds available for shorter duration and also certain target maturity funds. We can probably cover that later in a subsequent session, but any debt fund for that matter, you can consider, say another up to 25% to give you further stability. Remember in the previous slide, the suggestion that I had given, there was a core equity allocation through the passive equity fund, and there was a balance advantage fund. The balance advantage fund had a mix of equity and debt. So there was debt already present in that portfolio, which is why there was, I had not provided a separate column for another debt offering. So therefore, here we've given exposure to equity, to commodities, and also to debt separately. Now, if you want to consider a low-cost passive fund, you say that you don't want to take the risk involved. So while you are okay to probably forego some of the upside that probably the active fund management would would come with, you want a relatively cheaper fund and you just want the index to be followed. In that case, you can consider the Nifty 50 index fund, which is the top 50 stocks, about 40%. So you can then consider a mid cap exposure and a small cap exposure. Now, there are very interesting offerings available in the industry. Basically, for a mid cap, it gives a little bit of a twist. So from the 150 mid cap companies, so 150 companies that are classified as mid cap, there would be 50 stocks only. So you won't be investing in all 150 stocks. You would be investing in only 50 stocks out of those 150 eligible mid caps. And that is basically investing in those stocks which are seeing momentum in their price. Now, this is called as factor investing. That is basically you are layering your market cap, that is your 150 stocks, you would add a layer or add a further formula to see stocks which are seeing some kind of a price momentum and going upward. And therefore, the index would then decide to have allocation to those stocks. So these are 50 stocks is called Nifty Midcap 150 Momentum 50 Index is what you can consider. Then there is a simple small cap 250 that is basically investing into small cap stocks. 250, the entire 250 universe of small caps. And these are again weighed by market capitalization. So the higher weightage in terms of market cap to a particular small cap stock would have a higher weight in this particular index fund as well. So Nifty 50 large cap, the momentum flavor on top of the mid cap, and a simple small cap index fund is what probably also you can consider 40 30 30 or 50 25 25 basis your comfort and risk level. Now, someone who would like to again get a flavor of active and passive. Now, this basically covers again your entire universe like we did in the previous slide. We took exposure to large, mid, and small. This particular strategy also in front of your screen that you can see is also taking exposure to large, mid, and small, but in a different way. Now, this is giving you your core exposure again to the same index fund that we had referred to earlier, which is a Nifty Large Mid Cap 250 Index Fund, which is your top 50 next and 150 mid cap companies. And this is an active small cap stocks, small cap fund. Now, basically, a lot of people would really, because in India, there can be alpha or additional return that can be possible because of the expertise that a fund manager gets with himself. So therefore, therefore you can look at an active small cap fund instead of going ahead with a passive fund, because a passive would invest in all 250 companies, right, of small cap universe. Here they would look at select where opportunities exist. And probably see small cap companies can be relatively lesser traded also. So from a liquidity perspective, also probably the fund manager would say that, no, I don't want to take any risk with any company. And so they would apply a lot of risk filters as well before they go and decide that what kind of a small cap stock they want to invest in. So therefore, somebody who wants the expertise and get that relatively higher return out of their small cap exposure can go ahead and invest in an active small cap fund. So this is another way to get exposure of broadly the entire market, which is I'm representing through, say, the top 500 stocks that are listed. So 250 stocks through a passive fund, and the next 250 stocks through an active small cap fund. Now, this is again, if you have to take exposure to the entire market of the top, so largely when I say top 500 stocks are relatively, you would see a higher volume and higher trades, higher liquidity, higher level of acceptability, higher level of research. There would be a lot of analyst and research available of these among these top 500 stocks. So therefore, I'm sticking to that when I'm giving examples here. So there is, you can go ahead with an active large cap fund, an active mid cap fund, an active small cap fund for the same reason that I mentioned to in the previous slide. So here again, the fund manager would decide which stocks to pick from the large cap universe separately. then that is one fund. In the mid-cap fund, they would decide which mid-cap stocks to invest in, and then similarly for small cap. This is the active management that comes in. There is another interesting opportunity available in the market on if you want to take exposure to international stocks. Yeah, sorry. So there are opportunities available through US, or you can invest into US stocks. You can invest into US stocks which are technology focused. Now, how this really works is you invest in an Indian mutual fund. The Indian mutual fund would then invest through another vehicle into these specific stocks. So therefore, that gives you the international exposure also. There have been a lot of conversations. You would see that around that a lot of us who do have a set portfolio of Indian stocks are not really further diversifying away and taking that additional risk of looking at other geographies. So of course, because we feel we have more knowledge of relatively higher knowledge of what's happening in India, we would find more comfort here. But there would be experts available who are or have better knowledge on investing globally. So therefore, these are also set of companies or set of funds that you can consider to include in your portfolio, which are international. There are not just US broad market or US tech focused. You also have funds which have exposure to China, to certain ASEAN countries, and also European countries. So depending on your comfort and the level of risk you're willing to take, you can also seek international exposure as well. So say, for example, you want to take exposure to international, domestic, then you can go ahead. You can invest in an active multi-cap fund. This can give you exposure to international as well as India. Multi-cap here, this is an active fund. If you recollect in the previous slide, this would have minimum exposure of 25% into each large, mid and small. And so which is why this has a very well set rule that this is a minimum market cap wise exposure, and then within stocks, the fund manager can decide which stocks to invest in. So this would give you exposure across different market caps. So large, mid and small cap stocks. So 50-50 is what probably you can go ahead. Now, before I close up and take for Q&A, I think I really would like to leave you with this message that, what is at the core of wealth creation? According to me, for you to be able to create wealth is that you should have a good investment experience. What I mean by that is, say, for example, over a 15-year period, the Nifty 50 or the markets would have given about 15% of returns. So you would say, okay, great, that if I stay invested for 15 years, I would also get 15%, which probably if you would have over the last 15 years, you would have realized that. But what we forget is that, when you actually go ahead and invest, you go through different types of periods. This is one period that I have marked out between 2009 and 13, where you saw a significant level of drop in the Nifty 50 index. Another period between 14 and 19, that there were two such periods when the prices dropped down. And again, another period in 19 and 24. So what I'm really trying to imply is that a lot of times when the market starts to go down, the investor gets scared. And due to that reaction, due to that emotional bias, the investor would then say that, okay, no, I want to exit. Now, if you decide to exit, and then again, you try to time the market, try to enter, you may enter at the top, you may not really then get that desired 15% return. So which is why it's very important to stay invested. And basis what your risk level, your appetite, your investment horizon, your goals is what you should decide your different investments that you go ahead and invest into. But always remember this, that for creating long-term wealth, you really have to stay invested and to experience the entire journey. So there are ways that this is basically what I like to summarize, that there can be ways to enhance your investment experience and smoothen your investment journey. One way was of the hybrid funds that I referred to, which have an allocation to equity and debt. The other is you structure them through an SIP or an SWP. SIP is what I have mentioned to, that on a monthly basis, you can decide you will keep investing and not really try to time the market. SWP is the opposite, that is systematic withdrawal plan. That say, you enter a phase where consistently you need some money to keep coming. Say you have a rent to pay, or you're into your retirement and you have certain expenses to pay. then you would decide that on a monthly basis, you want, say, 5,000 to be withdrawn and hit your bank account, right? So that is a systematic withdrawal plan that you can sign up for. There are several other features that are enabled to help you also to make your mutual fund journey smoother and give you a relatively better experience. So just to summarize, these are the points that we had discussed, that while shortlisting funds, you need to look at your asset allocation, your investment horizon. Then you move on to the scheme or category objective, what all are the constituents of the portfolio, the tax implication, consistency of performance, not just looking at trailing returns, looking at rolling returns, and then certain risk ratios and measures as well. For example, standard deviation, beta, etc. So any questions probably we can take up at this point? I think we're almost nearing close of our time. So I can be reached out at any point in time for any queries, or if any further any aspect of mutual fund investing needs to go into details. So I'll be happy to take probably a follow-up session if required to go even into detail. I understand this can seem a little overwhelming when you read or when you go through something like this for the first time, probably. So yeah, we can help you through the journey as well. The entire CA community, of course, and we can probably do another session, but I would strongly recommend that you also look at a mutual fund advisor or distributor. In fact, on the website of Edelweiss Mutual Fund, there is a tab which says find a distributor, and depending on your PIN code, your city, there would be a list of distributors. So depending on your comfort, if you know somebody, I would strongly recommend that you consult, or you start your investment journey, or look at an advisor or distributor who has enough knowledge and can help you through the journey as well. So yeah, thank you. So can we wrap up the session?
Yes, Kinjal ma'am, are you there?
Yeah.
Yeah. So maybe give vote of thanks now. Kinjal ma'am, can you give vote of thanks?
Yeah. Hello. Good
Yeah.
evening, everyone. It has been such an honor to be a part of this wonderful webinar. Many thanks to our wonderful speakers, CA Sikha Sood ma'am, for apprising us and enlightening us on the different categories of mutual fund portfolios regarding different categories and risk and returns. And also thanks, I extend my gratitude to all the I extend my gratitude to all for taking time to join the session and making it very successful. Thank you.
Thank you very much. Thank you.
Thank you so much. Thank you, ma'am. Vinu, please wind up the meeting now.